Josh, thank you for joining us. Before we get into what you're doing in buying and selling, you had a great record academically as an economist. Why did you choose money manager, being a money jockey, rather than having a dazzling career as an economist and getting the Nobel Prize?
Well, it's nice to be with you. Thanks. Economics is a wonderful science, but I like the more practical aspects of investing and the fact that it touches things like business and strategy and beyond that, even psychology and behavioral aspects. And I like helping to allocate capital and try to do well for our clients.
As a youngster, were you always interested in the stock market?
I have been. I know you've probably heard that story before, but ever since I was a small child, my father got me interested in stocks, and my first one was Topps Baseball Card Company, and I also
Perfect
had
for a kid.
Exactly, Apple Computer, which I wish I still had today. Those
Yes,
shares.
You'd be on our 400 list if you had. So you went to Fidelity, and then you went to T. Rowe Price, which some would equate going from the Red Sox to the Yankees. How did that come about?
Well, Fidelity was my first job after business school. I went to University of Chicago, and Fidelity's a wonderful firm. Loved my 4 years there and learned from some great investors, including some mentoring sessions with Peter Lynch that the young analysts get to attend. But I have family ties in the Mid-Atlantic region. I grew up around Maryland, and coming to T. Rowe Price was like coming home for me. And I love the culture at T. Rowe Price. It's an open door policy, very collegial environment, a lot of sharing of information, and I've been there 10 plus years and loved every minute of it.
On just a general philosophy, money management versus indexing. How do you tell people it's worth going into a fund, expenses and all of that, rather than just dumping it in an index fund?
Well, the data, points one way, but at T. Rowe Price, we've got a great long-term track record of investing and making good decisions for clients. One thing that we do that maybe some others don't is we take long-term approach and we invest alongside companies, and within the technology industry, we try to invest in long-term winners and disruptors, and we've been able to show some very strong performance with that approach. It's not easy. It's a competitive market out there. And like I mentioned before, you have to combine not just the fundamental analysis, but also having a strong stomach and some aspects of psychology so that you can beat the indexes.
On that, since your funds are open funds, open-end, how do you may have a long-term philosophy, but as we know, these things go up and down. How do you cope with the inevitable money pulling out when they shouldn't and money pouring in when it shouldn't, in the sense that they always get in at the wrong time?
It's hard. We do attract investors who are like our long-term approach, and you'll see in our advertising and speeches that we make that we preach long-term discipline. Of course, when you see the volatility in the market, it's hard for individual investors to understand the ups and downs and stay with it, but we try to encourage that. I also will say I use the ups and downs of the market as an opportunity. Despite the fact that it's stomach churning, it actually can create great entry points for wonderful companies, and we see that time and time again in technology. Things that you wouldn't expect, they go on sale, and if you step in at the right time, it can really help performance.
So do you keep a certain amount of cash on hand just in case something comes up, you have the wherewithal to do it?
Of course, yeah. I try to keep at least 2 or 3% in cash in the fund to manage around withdrawals and the ins and outs of cash flow. I usually don't make a market call around the cash position. It's something that's held in reserve as opposed to something that's meant to represent my view on the market.
Now, two of the big funds, one is obviously Global Technology, but another one is called Science and Technology Fund. Can you, what are the differences between the two?
Well, Global Technology Fund is the one that I manage, and Science and Technology is managed by my colleague Ken Allen, who's also a long-tenured T. Rowe Price investor. We both work with the same team of analysts. Ken actually came up as a software analyst. I came up as a semiconductor analyst, I've spent a lot more time in Asia and Europe, and over time, you'll see more of the fund invested globally. Right now, it's at the lower end of the spectrum. I've got about 20% of the fund overseas right now, but the Global Technology Fund, from time to time, can have 40 or 50% of its assets overseas. And the
So
science
it's really a geographic difference between the two focus?
that's the biggest difference. Yeah, the investing philosophy is very similar.
Your philosophy on new versus mature, incumbents versus the disruptors. How do you move forward with that?
Well, technology is an industry that's rife with disruption, and we've also found that in many cases it's a winner-take-all market. And what we like to do, the ideal scenario is finding these young winning companies at an early stage in their life cycle and staying with them as they ride a wave. If you think back over time, great wealth has been created in stocks like Microsoft, in Apple, in Google, in Priceline. If you look overseas, companies like Baidu or Alibaba, we're trying to find those as well as the future generation. Tesla is one that I'm looking at today that's a big holding where I think they're really disrupting a big market. We could debate whether it's automotive or technology, but it's really at a crossover point.
Is that why you have private offerings in your portfolio? That's kind of unusual, especially for an open-end fund where people
That
can
is
withdraw
part of
the
it.
money.
Yeah, we think that getting to know the private companies helps our overall understanding of the tech industry.
And what's
And
emerging?
That's exactly right. What's under the covers, because even the companies that look like today's disruptors, there could be a minnow swimming around in Silicon Valley or in Beijing that we would like to know about, and maybe even put a small stake in the ground to watch it grow. I'm very selective with private investing. We pass on many more deals than we do, but once in a while we can have a big winner come out of the private market.
What have been some of the winners? Dropbox or?
Yeah, Twitter was actually a very big one for us. We invested at less than a $1 billion valuation, and the company's market cap today is more than 30. So that's what's possible in the private market. Now, they're not all that way, or it would be easy, but Evernote is one that I have high hopes for in the future. That's a really wonderful productivity tool that you see across the workplace, across enterprises and consumers, and basically does a lot of the things that you would have hoped Microsoft would do with Microsoft Word, but Evernote beat them to the punch.
Seems to often happen.
It does. It's funny because you would think some of the features and functionality is easy, but sometimes a big company can have structural impediments to addressing smaller markets. Maybe it's lower ASP or even free, and they're hoping to upsell, and it can disrupt the profit model of a company like Microsoft or Oracle. But eventually, those companies tend to move up market, and that's where the disruption and the economic growth comes.
The fact that the question is being asked probably means that we don't have to worry about it. Bubble, everyone, of course, still remembers
Yeah.
2000.
I-
And today there are numerous billion-dollar IPOs. They almost seem like confetti these days. NASDAQ, almost back to the giddy highs of 15 years ago, skirting them,
Mm-hmm.
sometimes touching them. What's your feeling? Is it fully valued again, or do you...
Well, it's a good question to be asking because we are back at the highs. I mean, we both remember the last bubble, and although there are signs of excess today and full valuation, it's nothing like what we saw back then. Multiple companies in the hundreds of billions or companies in the tens of billions that didn't have revenue models, much less profit models. But there are signs of excess, particularly in the private markets. We touched on private investing, and I do have some private investments in the fund, but it's at the lower end of the range that I might have. And within certain pockets, there's overvaluation, and the market as a whole, we've been through a 5-year bull run. It's much harder to find good ideas. There are some companies, in fact, some very good companies that have been left behind by the market, companies like Google, Amazon, Priceline, and those have become big holdings for the fund, and that's a function of the fact that they look relatively undervalued against a richly valued market.
So that's really bargain hunting, not, we don't think of that with technology.
Not always. The great thing about the environment we're in today is that some of the companies that have been left behind are actually some of the very best companies out there. Priceline, for example, dominant force in online travel, but they happen to have a lot of European exposure. And because of the euro weakness and concerns about economic growth in Europe, the stock has dramatically lagged over the past 12 to 18 months. To me, that signals an opportunity and a chance to buy into this wonderful franchise.
The cloud, everyone talks about the cloud, but some say because everyone is jumping into it, it's becoming a commodity, and the fat margins are going to be hard to come by.
Yeah, there's some truth to that. I think cloud will be a tale of two cities. So the cloud is infrastructure. There's an infrastructure layer that's dominated by Amazon with their web services business. That's providing outsourced compute and storage and networking to companies that don't want to run their own data center, feel like Amazon can do it better, faster, cheaper, and realistically Amazon can. There won't be a lot of margin there, but Amazon may be able to upsell services on top of it. In fact, I'm betting that they will be able to. Then there's another aspect of the cloud, which is businesses that are enabled by the fact that Amazon exists, that the cloud exists. Companies like Salesforce.com or Workday, whose software sits on top of the cloud and uses what they call a multi-tenant architecture, so that all the companies that are users are pulling from the same software base, as opposed to installing a single copy at each location. Those companies, it's actually a cost of goods sold for them, so cheaper compute means higher margins and more ability to focus on product and differentiation.
Well, Salesforce has had some ups and downs, and you feel now that it's on the upswing again?
I do. I love the company. I love what Mark Benioff has done with having multiple product lines, not just marketing, but also Service Cloud. He calls Salesforce now the customer company, and you see widespread adoption by companies like Home Depot or General Electric, who are using Salesforce for their front line of employees to help with things like inventory management, customer service, marketing, and really enabling productivity and growth for companies that are finding it hard to come by otherwise.
Google, you mentioned, it's been in the
Yeah.
long time in the doghouse, large stash of cash. People felt that the glasses and the driverless car are all kind of dust to get around the fact that they aren't what they were.
Yeah.
But you see real stuff there. What makes you bullish on it?
I'm really bullish on Google. It's one of those companies, great company, I think in many ways most folks would agree. And then you would look at the stock chart and say, well, this doesn't look like a great company. It's sat at this level for the past 18 months. Why is that? And part of it is that Larry Page and Sergey Brin have done some projects like self-driving cars and Google Glass, and they've also built up this big cash reserve, $60 billion, and they haven't done a buyback, they haven't paid a dividend. I would say we'll take the long view. They have some wonderful franchise companies, Search, YouTube, Android, Chrome, Google Apps, Google Maps, fantastic growth businesses, fantastic generators of cash. They just have a new CFO who came over from Morgan Stanley, or she's in the process of coming over. I think that the company can make progress on deploying that cash. I would not be surprised within the next 1 to 2 years to see a dividend, to see a buyback. I think Google...
So they'll go the Apple way?
I think so. And I feel like Apple has picked a lot of the low-hanging fruit and has been a very good stock. There's wonderful things about that company. But they've done a lot of the things that I expect Google to do in the next 1 to 2 years. And as a result, Apple looks more fully valued, whereas with Google, it looks like the opportunity is still ahead of us.
You went against the market on Apple. Why?
Well,
You don't have it anymore, do you?
in both ways, because it was actually the largest holding in the fund when the stock was depressed about 2 years ago. Remember, it fell all the way from 700 to below 400. I remember it painfully, and I added to the position on weakness. And then as it steadily came back, and coming into late last year, I reduced the position, thinking the market value is now back above $700 billion. Wonderful company, but the stock opportunity looks a lot less to me. I think there's much better stock opportunities in Google and Amazon today.
Is Apple, in your mind, just a one-product company when you strip it away?
It is. They get 80% of gross profit from iPhone. So a lot of the critiques that folks had about Apple during the challenging times that it was a single product company, that's still true today. They're trying things like Apple Watch and Apple Pay. It doesn't look like it can move the needle financially anytime soon. And unfortunately, the iPad hasn't turned into quite the growth driver that we hoped. So at the moment, it's very dependent on iPhone. And I think the next leg of the story for Tim Cook and team will be to further diversify the business.
Gets to the Internet of Things. What more can Apple do? The radio didn't work out that well, did it?
Yeah, well,
And you don't have much hope for the watch.
unfortunately for Apple, when you have $200 billion in revenue and $50 billion in free cash flow per year, it's hard for almost anything to move the needle. That doesn't mean they shouldn't keep trying. They should. And the Apple Watch will have future generations and will get better and better. But I don't think it'll move the needle anytime soon.
Amazon.
Yes.
They took a hit. You bought on weakness. But others say, like our publisher, that they're battling too many fronts. They're battling Apple devices, Google Cloud Services, Alibaba and others in commerce, FedEx and UPS on rapid delivery.
Yeah.
Can they fight these multiple fronts and be a strong company?
They can. They have two very, very strong businesses. Online retail, which we all know and love, the one-day delivery, the Prime. They have estimated 40 to 50 million Prime subscribers, paying them almost like a Costco model, pay up front and then benefit from services over the year. And they're building a fantastic moat around that business. And frankly, I think here in the US, Amazon's retail business is much more profitable than people realize. And the investment is really in overseas expansion and in the web services, the cloud computing division that we talked about. Within cloud computing, they are a leader. I think they'll have to move up market with services to drive meaningful profitability there, but I think they're far ahead of anyone else who's in that game. I'm not sure I love the hardware strategy, the Kindle, the Fire Phone, but I will say, over time, Jeff Bezos has had a fantastic track record of placing bets, growing ones that succeed, and being willing to take chips off the table when they fail. So despite his reputation maybe as a mad scientist, I think he's actually a shrewd business person and will do the right thing by Amazon shareholders.
Didn't Amazon win a contract from the CIA against IBM?
You're right, they did, and
IBM appealed and lost.
They lost the appeal, and the interesting thing was it wasn't due to price. I think IBM actually was willing to come in with a lower price, but Amazon had the better capabilities. That's a sign of the times and how far Amazon has come with their cloud.
Which gets to the whole area of disruptors. What other disruptors you see out there? You've mentioned in the past companies like Zillow. Which ones excite you?
Zillow is a perfect example. Some of these vertically focused internet companies, Zillow, LinkedIn, Netflix. I personally think Zillow will do to real estate classified and real estate advertising exactly what LinkedIn did to Help Wanted. I think within 5 to 10 years, Zillow will be synonymous with real estate search. And this company that's doing about 500 or 600 million in revenue today could be doing 4 or 5 billion in revenue 10 years from now. and very high margin, subscription-based, recurring, because they're getting paid by agents.
So much for newspapers. Uh, what other do you mentioned LinkedIn?
Yeah.
What other ones do you see out there that are going to upend the old ways of doing
Well,
things?
I touched briefly on Tesla. I really do think that they have a better model, and I think if you talk to
Explain that, because
Yeah.
a lot of people feel if it wasn't for the subsidies and its green image,
yes,
that yeah, they got some neat cars, but most people wouldn't buy them. And if you have cheap gasoline, they're not going to touch them, fearing that they're going to run out of electricity if they go beyond the corner store.
I know the subsidies. I almost wonder if now it's more of a negative that people are concerned over the subsidies. But frankly, the most amazing fact to me is that the Model S has come out, and forget about being electric. It's one of the very best, if not the best, cars on the road in terms of quality, performance, reliability. That's no mean feat for such a small company based in Silicon Valley to upend the auto industry. The price point of the Model S starts at $70,000 and runs up to about $115,000. Frankly, most people who are buying it today aren't buying it for the subsidy or for the gas savings because the car is so expensive to begin with. Over time, as Tesla moves down market, maybe that'll be a more important factor, and we'll have to watch the gas price more closely. But for a company that this year will deliver 55,000 cars, I think we're talking about the potential to deliver 1, 2, 3 million cars 10 years into the future. And that would still put them at a low single-digit global market share and not as big as industry giants like GM and Volkswagen. What I think is that once you have a Tesla, people won't want to switch. They don't want to go back to the gas station. They love coming home, plugging in the car, and being good to go in the morning. And with some of the winters we've had in the Northeast recently, I think it only drives that point home further.
The whole area of robotics. What excites you there?
Fascinating. Some of the productivity enhancements that robotics can bring in factory automation and home usage. When you look at iRobot with things like their Roomba vacuum, but Fanuc with what they're doing with robotics in factories around China, and I don't want to say displacing workers, but maybe doing jobs that can be done more effectively or more precisely with robots. I think that's an area that's only going to blossom in the coming years.
Moore's Law
Yes.
seems to be on steroids now. I mean,
It's
how about every 8 days? It seems to, not quite, but does that mean that areas like making of aircraft, which has always
Mhm.
been evolutionary, you get a little improvement here, but it hasn't
Right.
had the kind of revolutionary impact technology that we've seen in, say, media and other areas?
I think you're right. As chip making, advances further and further, and as the content of electronics rises in more devices. When you think about an airplane, the cockpit electronics, the in-flight entertainment, you could say the same thing for the automotive industry, for the defense industry, for the healthcare industry. Products that at one point were simple are now futuristic, and I tell people that what we used to see in science fiction is now reality. What that means is that companies will have to innovate faster and faster to incorporate and stay up with the technology. Technology is enabling more and more capabilities, and it'll be incumbent on companies in other fields to put the technology to work. And Moore's Law is a driver of that.
You started your early days semiconductors. You saw what Intel
Yeah.
is doing. Are we going to see more of that consolidation now?
If the deal that is rumored with Intel and Altera goes ahead, 2015 through March or through April would already be the biggest year for semiconductor M&A through 4 months since the year 2000. And it's interesting. I think what's happening is the cost of advancing Moore's Law has gotten more expensive, and so companies are looking for scale. They want to get bigger so that they can amortize those costs around a larger suite of products. So it's a function of economic necessity to a degree. So yes, I think it will continue.
Intel a buy?
I do like Intel. I like what they're doing. I like their data center business in particular. When we talk about the cloud and the compute, all those servers, they run on Intel chips. And despite fears or threats to the contrary, Intel maintains a very strong position there. And the cloud has, in a way, been good for them, which you wouldn't have necessarily
Right.
thought. As computing shifted from the PC to the smartphone, you might have thought that'll be negative for Intel given that stronghold in PCs. But really, it hasn't shifted to the phone, it's shifted to the cloud. And that's where Intel lives now.
Josh, thank you very much.
Thank you.
Appreciate it.